Silicon Valley Bank, one of the largest banks in the United States, has spectacularly collapsed due to a bank run caused by customers attempting to withdraw their cash. The bank, based near San Jose, closed its doors on Friday after regulators stepped in to protect customers and prevent the collapse from spreading to other banks. This is the biggest bank failure in the U.S. since Washington Mutual collapsed in 2008. Silicon Valley Bank's shares plummeted by 60% in pre-market trading on Friday, leading to the closure. The bank specialized in providing financial services to the tech sector, with more than $300 billion in assets. The bank's crisis sparked a sell-off in European bank shares and volatility in U.S. bank shares. The collapse of Silicon Valley Bank, SVB, has sent shockwaves through the financial world, as it is one of the largest banks in the U.S. to fail since the 2008 financial crisis. The bank, which specializes in providing financial services to the tech sector, has been struggling with plummeting customer deposits, which led to a bank run as customers scrambled to withdraw their cash. SVB's parent company, SVB Financial Group, had announced its intention to raise $3.8 billion in fresh funds through a share offering, after having sold off $32 billion in securities at a loss of $2.7 billion, to confront the surge in withdrawals by clients. However, this was not enough to prevent the bank's collapse, and on Friday, the California state government and U.S. federal government stepped in to close SVB after fears that its woes could spread to the rest of the banking sector. The collapse of SVB is a clear indication of the interdependence of banks and the potential for contagion in the financial system. The misfortune of one bank can affect the confidence of investors in the entire sector across the globe. While the banking risk remains limited to a few U.S. regional banks, top hedge fund manager Bill Ackman compared the bank's troubles to the plight of Bear Stearns, the first domino to fall in the global financial crisis 15 years ago, and called for government intervention. The California Department of Financial Protection and Innovation, DFPI, has taken possession of Silicon Valley Bank, citing inadequate liquidity and insolvency, and appointed the Federal Deposit Insurance Corporation as the receiver of the funds. The move will protect customers with up to $377,000 in deposits and buy time to find a potential buyer of the embattled Silicon Valley lender. SVB's 17 branches will physically reopen on Monday under the control of the Deposit Insurance National Bank of Santa Clara, DINB, a new entity set up by the FDIC. Silicon Valley Bank's 17 branches will physically reopen on Monday under the control of the Deposit Insurance National Bank of Santa Clara, DINB, a new entity set up by the FDIC. DINB will maintain Silicon Valley Bank's normal business hours, the FDIC said, adding that banking activities will resume no later than Monday, March 13, including online banking and other services. SVB's focus on the tech industry made it vulnerable to deteriorating conditions for the sector, such as the sharp increase in interest rates, a weakening risk appetite among investors, and continued supply chain problems. Banks have also been impacted by the increase in interest rates. Although higher interest rates are generally good for banks as they can earn more from lending, a lot depends on the rate they have to pay to acquire funds.